Chapter 12, Geopolitics. Section 5, Geopolitical Market Reactions. Geopolitical shocks can cause markets to reprice very quickly, and the reaction usually spreads well beyond the most obvious asset. What makes these episodes different is the mix of fear, uncertainty, and forced repositioning, which can move prices, volatility, and capital flows across several markets at once. When investors read an event as a genuine risk-off shock, a familiar first wave often shows up. Stocks tend to fall, safer government bonds may catch a bid, oil or other key commodities can jump on supply concerns, safe haven currencies strengthen, and volatility rises across the board. Not every tense headline deserves a major market response. The biggest moves usually happen when the news is unexpected, economically meaningful, and carries a real chance of escalation. Repeated rhetoric, by contrast, is often treated as noise. A simple way to tell whether you're looking at a true geopolitical shock is to check three things: speed, breadth, and volatility. If prices move sharply right away, several asset classes react together, and hedging gets more expensive, you're probably seeing a broad repricing rather than a narrow local story. These reactions often follow a sequence. First comes the shock, sometimes when cash markets are closed. Then investors assess what is actually new and who is exposed. Capital rotates towards safety. Options markets quickly reprice uncertainty, and only later do prices either retrace or settle into a new range. The first effects usually hit the assets with the most direct exposure, creating immediate winners and losers. But the story rarely stops there, because contagion can spread through currencies, equities, bonds, inflation expectations, and earnings as second-round effects start to matter. Volatility can be especially informative during stress. If implied volatility jumps outside the normal economic calendar, markets are often paying up for protection against uncertainty, and when spreads widen at the same time, that's a strong sign the concern is broader than a single headline. The 2022 invasion of Ukraine is a clear example of how one geopolitical event can move many markets at once. The ruble dropped sharply, European natural gas surged, European equities came under heavy pressure, U.S. treasuries benefited from safe haven demand, and U.S. stocks fell initially but recovered faster as exposure proved less direct. In practice, the goal is not just to react fast, but to classify what kind of shock you're dealing with. Start by reducing or hedging the clearest exposures. Look for holdings that may offset the damage. Then watch energy, shipping, policy signals, and safe haven flows to judge whether the move is temporary, escalating, or becoming a more durable repricing. A common mistake is assuming the first market move tells the whole story. Better decisions come from separating the emotional headline reaction from the slower economic effects, while also paying attention to contagion, liquidity, execution risk, and the indirect exposures that often do the most damage later.